Good morning. It's Wednesday, March the 12th, 2025. I'm Zach Howard. Here's your 3-minute morning market update. Three things in my notebook this morning. US CPI, second, volatility as it relates to that, and third, Bank of Canada Day here in Canada. First up, US CPI came in lower than expected at 2.8% year over year. Forecast was for 2.9%. Month over month core CPI at 0.2% versus 0.3% forecast. What does that mean? That means there's continued bias for this continued disinflationary macro regime into Q2. Slowing growth, slowing inflation. Asset classes that benefit best from that backdrop usually are stuff like gold, bond proxies like yields related to REITs, housing sector, stocks, etc. Back to the second part of that CPI, now we have that pass, the volatility of the market has suddenly pulled down significantly for where it's been elevated going into this event. That should leave a short-term bounce potential in risk assets and higher beta sectors that have been under pressure in this volatility backdrop. Third up, the Bank of Canada. Judgment Day here today. Rate cut expected, 25 or 50 basis points. My bias going into the meeting as of yesterday was a 50 basis point cut. They want to get out ahead of the economic slowdown that is coming because of the tariffs. Particularly the auto sector in Ontario is going to be heavily hit with all these policy changes and uncertainty out there, really hard for business to plan. The federal government, along with the Bank of Canada as its partner, we're looking to continue to ease the economy as it continues to slow. However, we look through the 5-year Bank of Canada bond yield, it's kind of stabilizing here at 2.65, 2.7% going into the meeting here shortly. So we're probably going to be continuous 25 basis rate cuts throughout 25 as the economy slows at a faster pace. Looking forward to what happens next, we have Bank of Canada also now has a central banker in charge of the federal government, Mark Carney. So I would expect to be working hand in hand going forward with lots of stimulus. The housing market in certain sectors of the country, like we're onto in the East Coast, should benefit from lower mortgage rates, particularly as those floating rates continue to fall. However, we look through the housing market in the GTA, had its worst month-over-month sales seasonally adjusted in February, going back since April and March of 2020. The COVID lockdowns, and previous to that, it was the worst month since the GFC in 2008. Out to the West Coast, Vancouver continues to have record high inventory levels built in its investment condo market. So short-term relief by Bank of Canada Day won't really help the stress in those markets, the GTA and Vancouver, but here down in East Coast of Canada, already short on inventory. This here today should be a further tailwind for further increase in housing demand going into the summer months. See you tomorrow.